housing market just changed. Can you feel it? Stick with me today and I'll show you why. That's right, we're starting to see cracks and signs of this housing market cooling everywhere. Think about it, for the last few years, this real estate market has been stretching like a rubber band, and eventually it can't stretch anymore. Cracks start to form, and eventually it softens and comes back to its original format. How, you ask? Or why? Welcome, this is JW, Mr. Downtown Delray with EXP Realty in Delray Beach, Florida. If this is your first time on my channel, please go ahead and subscribe and hit that bell so you're notified every time a new video drops. Today I'm talking about the 4 I's. Those are inventory, interest rates, inflation, and iBuyer investors. And they all have a big part about what's happening in this real estate market. But before we begin, I want you to stick around to the end of this video. If you are an investor or someone wanting to invest in real estate, my old partner and I, we put together this spreadsheet about 25 years ago when we were buying apartment buildings. You can use it for homes, you can use it for condos, but at the end I'll explain to you how it works, and I'll provide a link below for you to get that free investment guide for you to start investing today. So let's start off with number 1, inventory, which is supply. That's the biggie. There's supply and demand. Well, inventory is our supply. And here's the thing. Over the last few years in the United States, we've seen inventory of available properties drop over 68%. Back then, about 2.3 million properties were available in the United States. Right now, just about 730 properties available. That's a dramatic drop in available properties. And here locally, I've been writing to my subscribers of my weekly e-letter, and if you want to join my weekly e-letter, please go ahead and send me a text, send me an email, give me a phone call, and I'll add you to my list. And what I've been writing about is the local inventory here in South Florida. So about 2 years ago, there was always about 54,000 properties available for sale. And that plummeted, man. It went down about 68% to just under 15,000 units back in November of last year. And it's been hovering around 14,900 for the last 6 months. Well, just this week, it cracked above 15,000 available units for sale at about 15,125 properties. That is a piece of data that for local real estate people is important to watch. And I'm sure there's lots of reasons why now inventory is starting to slowly creep up, but enough for me to do this video. It's because here in Florida particularly, it's a retirement community. So we have a lot of people in the 55 and up range, or even 65 and up. And over the last few years, those folks have not been allowing people into their homes to take listings. They were afraid of where to go. They were afraid of COVID itself. So they were not allowing any activity to happen within their homes. So we were basically off limits. Today that's changing. I think that's a part of why we're starting to see inventory numbers tick up. And if you're any good realtor out there looking at data, they should be telling you the same information. Whether you live in Arizona or Chicago, they need to look at the local inventory to see if there's been any spikes or any change in the pattern. And that's exactly what's happening here in Florida, which is one reason why I believe locally we're starting to see changes in the real estate market. And this plays into pricing as well. So for sellers who are asleep at the wheel and who might not be getting the right advice from their agents or whomever about selling their house and paying attention to these inventory levels, well, guess what? As inventory rises, that means more competition. And when more competition happens, you might see the need to reduce the price. Take a look at this headline here from Florida Realtors, and I'll put the link below to the article. You can check out yourself. It's quite shocking. Next up are interest rates. I don't want to talk too much about it because you can read about interest rates all over the place. We know that they went down to 2.8% last August, and now they've gone from 2.8 up to 5.3%. But here's the thing, how often do you see interest rates rise over, let's say, a 30-day period by 25 to 30%? Or in the last 7 months, they've gone up almost 70%. These are extremes that eventually are going to slow down. And a lot of us now understand that the Fed is going to raise rates this year, whether it's 4, 5, or 7 times. We understand that rates are going to go up, which will have an effect on our mortgage rates. But here's the thing. Right now, rates are at 5.35%, and that's having a dramatic effect on how many buyers are out there and how much they can now spend and afford for property. So let's keep a look at interest rates. They are going to remain high, but I think now that the information from the Fed is already out, that things are going to become less bad. The next I is iBuyers/investors. What jumps out at me first is something that a lot of people might not be paying attention to, which I think might be unique, and that's these iBuyer companies. Several of these iBuyer companies are traded publicly on Wall Street. You can own their stocks, like Zillow, OfferPad, Open Door. They might not be a direct link to what's happening in the shift of the market, but let's take a look at their performance of their stocks, because we might see some interesting insights. So let's take a look at these three stock charts. First, we have Zillow. Everyone knows Zillow. It's the big monster in the room. Their stock was a darling of Wall Street for years. But last November, they got rid of their iBuyer program. I standing for instant buyers, where they can come in and buy properties for cash. Well, look what's happened to their stock since its peak. It's down about 76%. That's a crushing blow to a major stock on Wall Street. Next up is Open Door, also another smaller but well-organized iBuyer program and company. Look at them, they're down 67% from their highs. And last is OfferPad, very similar to Open Door. From their highs, they're down about 75%. Now, here's the thing. Looking at stocks like this might be a leading indicator to what's happening in the future. So if these iBuyer programs, which are the investors, their stocks are down, that means their market capitalization, or the cash they have on hand, has shrunk. So with that less amount of cash to go invest, with high interest rates and high prices, we might see over the next 6 or 9 months another reason why the market is cooling, that there's more cracks in the market, because a lot of these big investor companies that can go out and buy 5,000, 10,000, 20 homes at a time, that might be drying up, because guess what? Their stock market's down and their cash is gone. And the last I is, guess what? Inflation. Inflation's driving everybody crazy. But here's the thing, over the last 20 years since the millennia started, inflation in the States has been averaging somewhere around 2 to 3.5% in that ballpark. And they call that kind of normal and standard inflation. But last year, because of all the trillions of dollars that the government has printed and money flowing and a whole other myriad of things that's happened, interest rates have gone from, let's say, 3% to 8.5%. I don't know about you, I'm exhausted, man. It used to cost me about 25 bucks to fill up my gas to take my daughter to high school. Now it's costing me 55 bucks. Gasoline is through the roof. My weekly grocery bill used to average about $150. Now it's pushing $225. I'm getting exhausted, and a lot of people are getting exhausted too. Just take a look at this headline for a second before we dive into some other information. Things like homes are up, rent is up, gas is up, car prices are up, food is up. Take a look at this information. In March, inflation accelerated to 8.5%, the strongest pace of inflation in 40 years, due to rising prices and average consumers spending $511 more per month compared to a year ago. Annually, this works out to about $6,000 more now compared to a year ago. And look, they talk about energy and commodities as fuel and motor oil saw an inflation rate of 48%. That's the steepest growth it's seen for years. The price of food rose 8.8% last month, with prices of food consumed at home rising on average of more than 10%. Oh my gosh. Commodities are up. Look at that, 11%. Service expenditures also rose 4.5% on average. Airline fares. I haven't been on an airplane for several months, but look at that, 24% increase just to get on a doggone airplane. So overall, this is hitting buyers and consumers in the pocket, and this is a drastic information. If people can't afford food or gas, how are they going to afford home prices at this level when interest rates are at this level and everything else is level? That's part of the rubber band expanding, and those are the cracks that we're seeing, and the rubber band is going to start snapping back into place the more and more time goes on. So that's it in a snapshot. The 4 I's, the very important 4 I's. And guess what? I do believe that we are right now seeing a pivot in the real estate market. I believe that housing is cooling. I think that there's a change happening based on all the data that's starting to show up, the headlines that are showing up, the whole mood of headlines and media is starting to change. I've been writing about this in my e-letter weekly to my subscribers. If you want to be part of my weekly e-letter, go ahead and send me your text, give me a phone call, send me an email, get a hold of me, whichever you want to get a hold of me. But what I want to do now is share with you my free investor spreadsheet that I put together over 25 years ago with my ex-partner. Look at the link below. You can click on it. All you got to do is give me your information, and I will provide that to you free and no charge. If you have any questions once you download it, call me, Let's get on the phone and talk about it. Basically, there's cells in there that you want to include, like the price of the property you're putting in, how many units are in there, what your mortgage rate is going to be, what the rent was, and what the rent upside looks like, and it will calculate all the returns, IRR, ARR, gross multipliers, cap rates, all that stuff will be produced for you. It's a phenomenal tool that I used. I used to put this out there without buying a property. I would run the spreadsheet through 50 or 60 properties before I would say one matched all the points that I wanted to make a good investment. It's for you, for free. Take a look at the link below, sign up, give me a call. Can't wait to talk to you next week.